Do you think we have the lows in place for 2018 or the grind will continue for a better part of this year?
Good morning. So our fundamental view still is that the grind looks set to continue because the risk reward to us is still not attractive at these levels. We have seen a market correction broadly similar to what happened globally, but India has underperformed its peers by 5% YTD. And the thing is, you look at last year, India did overshoot fundamentals because of local flows as well as global risk on environment. So the scenario for it to overshoot fundamentals again this year, the building blocks are definitely not there, unlike last year, except the local flows part, which still remains strong. So we won't advise investors to rush in at these levels. Of course, the long-term story for India still looks good, but for the near term, for next 1 year, the risk reward is clearly not attractive here.
Gautam, hi, morning, Aisha as well joining in, and I'm really tempted to say that your market view is sort of matching with your look. Is the look in lieu of the market mood and your market strategy?
Not at all, not at all.
Just kidding. Okay, so what do you do then, Gautam? How is it that you buy time in the market? Do you buy more of the same cream private banks, the Marutis of the world, construction names, road companies, or I mean, how long do you sit it out and wait it out for the market to show you those signs of a revival?
So even in a steady market or even a declining market, there are always sectors or stocks which give you opportunities to generate not just outperformance but also absolute positive returns. And our stance from a sectoral perspective, we see sectoral level overweight IT services as a big call. Then downstream oil and gas companies, we see the risk reward fairly attractive there. We like property as a sector. The risk reward there, despite the run up, seems very, very attractive. Then we also like private banks selectively, not in a broad-based way, but we are overweight private banks and not just the well-held big banks, but also selectively corporate private banks, despite the recent issues.
Okay. Well, Gautam, when you say valuations are not looking attractive, are you making a case that earnings will decline? Are you making a case that macros will haunt us? Or you like everything else, but you don't like the price levels?
So both, in fact, multiple factors. One is headline PE multiples for the market at around 17.5 times is still rich versus the last 3-year, 5-year average. It's derated over the last few months, but compared to last 3-year, 5-year averages of 15 times, 16 times, it's still quite rich. And unlike the re-rating argument over the last couple of years from declining interest rates, that argument has also become diluted. Secondly, top down, we do expect earnings cuts to remain a reality for Indian markets. So top down, we expect another 10% cuts in estimates for fiscal year 19. And lastly, forget the absolute price levels. In the context of the growth outlook, in the context of the building blocks for market sentiment, not just globally, for example, trade war, etc., but even locally, the political, this is a pre-election year, that will also drive market sentiment. We won't see any big bang reforms happen this year, but more of stabilization of existing reform agenda. The interest rate, the best of the rate cuts, at least seems to be behind us. So all the building blocks to drive market re-rating in absence of earnings growth, that's also behind us. So for us, it looks challenging to argue that you buy the market for a re-rating story or a strong earnings growth story. Obviously, this is all a 6-month to 1-year view. The 3 to 5-year view still remains attractive.